see this quarter as being very, very choppy, and as we've discussed in the past, October is full of big headlines. Very difficult market to invest in when you really have these binary headlines that you're waiting for. I agree with Dan here that the December 15th consumer tariffs really have to be put off the table. So there doesn't have to be a deal, but if there's some kind of stasis or some kind of just keeping it stable while we're still talking with China, that's probably enough to get some risk back into the market here. Other than that, we just really see this as a very choppy market dependent on macro headlines. Very hard to invest when you're waiting for macro headlines.
And Dan, what do you make of the analysis that Mike just did there and the importance of the tech stocks?
I was waiting for that. It's really interesting when you think about Apple. He just said it's right back to its prior all-time highs, $2 away from it. Okay, so really a smidge away. FANG in general, I like to use MAGA. It's Microsoft, Amazon, Google, and Apple. When you think about that, that is 40% of the NASDAQ 100. Now, Amazon and Google have just stalled out. They have not confirmed any new highs. Apple's about to make it, but Apple's up materially, from its lows. So how much torque do you think it has to the upside if it was to break out and make a new high? And then Microsoft has been stuck in a trading range for months. So when you look at these mega cap names, there are headwinds. Even if Apple, you ring the bell and it's a new high, I don't really care. What I'm most focused on is what is doing the heavy lifting. What does that rotation happen? Like I said earlier, it's utilities, it's REITs, it's stuff that's getting staples, really expensive for not a whole heck of a lot of growth, but deemed defensive. That's not particularly bullish with the S&P 2.5% off its all-time highs, in my opinion.
Alicia, when we look at the economic data, it seems, depending on where you sit, you could look at it glass half full, glass half empty. We know the manufacturing sector is weakening, but we are much more of a services-based economy. What's your viewpoint of where we go from here, and if we're going to talk ourselves into a recession because of what's going on manufacturing?
We actually could talk ourselves into a recession on the manufacturing side and on the CapEx side. To the extent that CEO confidence is much worse than consumer confidence. That's where you have CapEx and investment. And we've seen the fall off happen because of the uncertainty in what's happening with global trade. In the end, global trade doesn't really affect directly U.S. GDP all that much, but it's those secondary and tertiary effects that really hurt us. So if you look at the jobs data from last week, it turns out that the non-supervisory sector of the labor market actually had quite a pay boost, had a wage boost, and that really did not make it to the top line headlines. We're still confident in the consumer here. Actually, we think the jobs number, if you look underneath, was actually better than what it looked like on the wage side. And so to that extent, we think the consumer sector is probably still okay.